isn't perfect, right? We saw, like, when it came to 2023, Japan was the only market which saw growth in private equity activities pretty much. What's different this time around?
Well, I think they're going to be rate cuts. So I think that'll spur things. I think countries like India and Sri Lanka, which is a turnaround story, are going to present opportunities in the private space. So I think we're seeing a difference from 2023. We already see a pickup. Stock markets were at a high at the end of 2023. Inflation was curbed. And as I said, rate cuts are going to kick in, which will also spur investment activity.
Inflation remains really sticky. In fact, those rate cuts have been pushed back again and again. And some say, it may go from 3 to 2. So there are risks to the projections that you're making.
Absolutely. But there are always risks. But I already see a flurry of more activity in 2024 in the private market space than I did in 2023. 2023 was a very, very difficult year, with the exception of Japan, as you mentioned, where they were up, I think, 183% in terms of deal size. The rest of the markets were suffering. But we're seeing a turnaround now in terms of investor interest, in terms of people looking for opportunities. I myself have been asked in Sri Lanka for different investment opportunities. As you know, the IMF has made almost $3 billion of commitments in terms of a loan there. So, but there's some points that they need to adhere to in order for the provisions of that loan. And therefore, Sri Lanka has several huge assets which are being divested, and a lot of institutional players and investors are looking to come in, which will also spur activity there.
You talk about a flurry of activities. Quantify that for us.
So a flurry of activities, basically, I have a lot of investors coming to me and saying, let me be part of the India growth story. How can I be part of the India growth story?
But how big are these deals? What are you looking at?
Oh, I have the deal in Sri Lanka is about $250 million. In Bangladesh, we have a deal which is $1 billion potentially. In India, we've got deal sizes which are small, sort of $10, $20 million range, up to $500 million, right? So where you're looking to take a huge chunk of some conglomerate, or it becomes more like a merger and acquisition deal.
You got to wonder what the returns are in a market where different asset classes are giving good returns. You lock in 5% in bonds, and you see many countries are having record highs in terms of their stock markets. Why PE when you can just lock in and have good returns from some of these asset classes?
Well, I think India today has 111 unicorns, so it's the third largest country in terms of the number of unicorns. There you'll see returns that you won't see in the bond markets. You won't see it in the stock markets. And
yet we're seeing the likes of Paytm and Baiju's, which have failed and disappointed.
Absolutely. But Baiju and Paytm were a specific story which were driven by the COVID imperative, which they thought would last forever, right? But that's not the case. When interest rates rose and when COVID kind of stopped, those companies suffered. But other things like food delivery, so we have Swiggy, which is coming out, now has a competitor which is listed called Zomato. So you can always look to it to model Swiggy's trajectory, right? So I think there'll be more nuanced investment now, but there's huge opportunity because of the unprecedented growth we're seeing in countries like India, right? 7.5% projected. Inflation is benign, so there won't be stringent monetary policy. The population is young, hovering at around just under 30. So that'll also drive GDP. We were the 8th largest economy 10 years ago. Now we're the 5th largest economy, and they project we'll be the 3rd largest economy by 2027. So there's huge growth to be taken advantage of in those numbers for investors, both institutional and private.
What assumptions are you making about India's fintech ecosystem? What is there to be excited about?
Well, I think there's a huge amount of innovation in India's fintech ecosystem. We have a huge amount of talent, as I said, because we've got a young population. And therefore, they can drive growth. They can also bring prices down, right? So I think that those are two of the key factors that will drive India's fintech growth.
So tech as an asset class remains very attractive?
To investors, yes. Very, very attractive. But I would say commodities, energy are also supplanting it to some extent. So tech was the beauty queen, if you were, a few years ago. But now you have energy, commodities also being asked for.
Of course, when you talk about tech, you have to talk about AI. That's dialing right now. How do you invest in software and hardware? How best to do it?
Absolutely. So, but we have to make that distinction between software and hardware, right? So NVIDIA is driving the hardware. Software, OpenAI, is it going to be the story, or is there going to be a competitor that comes out? That remains to be seen. But one thing is for sure, AI is changing the trajectory and the landscape of investing, and in terms of how companies run in almost all domains, right? And I see it being a huge part of the future.
The thing is, investing in AI is investing in potential,
yes,
which is yet to be realized. What risks do you see there, and how do you guard yourself against it? How do you hedge against it?
It's difficult to always hedge yourself against risk. I think that's always that's Markowitz says it best. If you have return, you've got risk, right? So I think basically you have to take a punt. So OpenAI, there's a massive amount of interest in OpenAI. It's difficult to source. We've been dealing in blocks of AI for months now, where the trade doesn't quite go through. Sometimes it does, sometimes it doesn't. I think it's just knowing where to go and doing your homework. That's what really is going to prepare you for the investment landscape.
Okay, so if there's return, there's risk, but in this case, there's concentration risk because people are invested in the same asset classes, in the same companies, in the same way.
Absolutely. But, you know, if you look at something like Amazon, it's a large dominant player and there's concentration risk there too, but people have had outsized returns. So if they've got a winning idea and they're doing it right and they're implementing it right, the concentration risk is mitigated by how good that particular company is, but you have to be sure.
Any contrarian view?
Any contrarian view? I think at the moment, real estate and REITs have sort of not been looked at as much as they should have because, you know, COVID came about and everybody was working from home. So they thought, well, the office is defunct. That's not true. The office is still very necessary. And I think that some of those investments are undervalued and should be looked at. And also FMCG, the mainstay, foods, restaurant, all that needs to be looked at. Right now, the hubbub is around AI, but I think don't forget the mainstays.
The thing is, the office is necessary, but we're also seeing a lot of cutbacks in terms of manpower. In tech companies, we're talking about tens of thousands of workers.
Absolutely.
How do you look at that then? How do you assess that?
Basically, I just think that it's undervalued relative to where it should be. I'm not saying that it's absolutely at the scale it was earlier. It's undervalued relative to where it should be because while it may be diminished, it hasn't been eradicated. We still go to the office 2 to 3 times a week. We still have client meetings there. We still need it. So therefore, there's more value than investors are seeing. It may not be what it was.
For Avril and